안녕하세요. 월가월부 시청자 여러분. 반갑습니다. 오늘은 미국의 대표적인 자산 운용사인 티로우프라이스에서 미국 주식 전략을 담당하는 줄리안 쿡 포트폴리오 스페셜리스트를 모셨습니다. 약 30년간 투자 경력 중 대부분을 미국 주식을 담당하신 분입니다. 현재는 런던에서 미국 주식을 담당하고 있습니다. 오늘 쿡 스페셜리스트를 모시고 최근 은행 위기 등 주요 증시 이슈에 대해 들어보는 시간을 갖겠습니다. Hello, Mr. Julian Cook. Thank you very much for joining us today. Because you are staying in London, I'd like to ask about Europe first. So, how much risk does European bank industry face now, and when will it be back to the normal, do you think?
Yeah, I guess I'd say it's fair to say I think that Credit Suisse probably had more than its fair share of challenges over the last few years. And I guess we'd like to think that the moves made by the Swiss National Bank and UBS have got a long way to sort of cleansing those issues. But as we look into the sort of the wider perspective of European financials, obviously the market is obviously looking around and trying to find kind of like the next Credit Suisse. Deutsche Bank has obviously come under some pressure, but when we look at the things that matter, we think that deposit concentration, the proportion of insured deposits, it's really sort of difficult to sort of link what happened to Credit Suisse systemically to other banks in Europe. So we like to think it's actually pretty well contained, though it's not going to stop speculation and not going to stop investors sort of trying to identify what the next problem could be. But as far as we're concerned, the next candidate, Deutsche Bank, we think looks in a far different shape, far stronger and far more protected from a deposit insurance perspective.
I see. So basically you are saying that the European banks risk will be fairly contained.
Yeah, we'd like to think so, yes. I mean, of course, I guess we reserve the right to change our minds, I guess, but right now we think it's actually pretty well contained.
And then let's go to US. What about the US regional banks risk? How do you think the regional medium and small size bank risk will impact the US stock market?
Yeah, I think this obviously comes back, I guess, from what's happened at Silicon Valley Bank a couple of weeks ago. And I think we need to clarify the issues that that bank faced, just to sort of so we understand kind of what brought this about. Essentially, we had a bank which was had a liquidity issue as opposed to a credit or a capital issue, and by that I mean there wasn't a matching of the duration of the liabilities, i.e. the deposits and the assets on their book. And they found themselves with assets which were like too long in duration and their liabilities or their deposit were like too short in duration. They obviously suffered. We just mentioned concentration of deposits. They actually had a very, very concentrated deposit book. So as soon as the venture cap community decided to take money out, there's a very, very concentrated deposit base. So when we look for that similar kind of profile in other regional banks, I guess we struggle to find a bank as exposed to the same degree that we saw a Silicon Valley Bank. But I think you raise a good point in that I think we need to be mindful of the mid-cap banks, and particularly their exposure to commercial real estate. So that could be a potential credit issue of the future. People aren't going back to work as quickly as one would have hoped. And so that could put some of these commercial real estate loans at risk. So I think the mid-sized banks are probably a little more exposed to that dynamic, which is, I guess, a little different from what we saw at Silicon Valley Bank, a couple of weeks ago. So there are still issues, percolating in the economy that need to be worked through. But right now, maybe the relative risk in mid-cap banks is just sort of elevated, slightly.
I see. So I guess next crisis can be found in middle and small sized banks, commercial real estate loan, maybe.
Yeah, I think that's where people should really be thinking of looking when they look at that space. To run the measure over their commercial real estate exposures, because that may be the next source of risk.
And let's move on to next question. It's about the Fed. So even though the Fed is suggesting the terminal rate will be 5.1% at the end of this year, the market expects it to be much lower than that, like 4%. And why do you think there is such a big gap? And which one do you think will be right in the end?
Well, I guess firstly, we were surprised by the speed and the magnitude of the Fed rate hikes over the last 12 months.
Mm.
I guess we recognize inflation would be an issue, but the labor market obviously has proved to be more resilient. I think both the Fed and the market, I guess have the right again to change their mind. I think we can agree that it probably feels that we've gone past peak inflation. So I guess we'd like to think we're probably closer to peak Fed rates. I'd also observe certainly the last 2 weeks, given this dislocation in financials, the bond market has probably got a bit of ahead of itself in the last couple of weeks, trying to anticipate a reduction in Fed interest rates, given the pressures that are potentially building in the banking system. So right now, the steepness of the inverted yield curve between 3 months and 2 years is way wide at like 100 basis points. That's a huge spread, suggesting the bond market is of the view that Fed rates are going to get cut, sooner rather than later. I think directionally, I think they're probably right, but the magnitude, I think, is probably overstated. So I wouldn't expect Fed rates to go up and above 5%. I think we've reached the peak, and we'll be we'll be descending, we think, from this point forward. But the timing of that, of course, is obviously data dependent. So I wouldn't expect it to get down to the level that the bond market is predicting, because the bond market is currently building in, I guess, a bit of extra pessimism that has occurred over the last 2 weeks at the moment.
Mm. And next question is about recession. Recession fear is spreading over the bank's risk. As you mentioned, the inversion, as you mentioned, is getting very big level, right? And do you think recession will come? And then if yes, and when it will come, and how big will be?
Yeah, I guess from our perspective, we don't think it's possible to reach the Fed goal of price stability of 2% inflation without putting the economy into recession in the process. I think the Fed has been very clear that they want to get inflation under control, almost like at any cost, and that cost at the moment is going to be the strength of the growth in the economy. Don't forget, the economy has received large fiscal stimulus. It's been on the back of quantitative easing for a long period of time, and low rates. So that's been an environment that's persisted for a long period of time, and you're trying to sort of wean people off that sort of environment of that kind of growth. I guess supported by so much kind of monetary ease in the economy. So I guess we think there is a recession coming. The timing of that, we think is I guess we probably would have called it, I guess, too soon. Right now we're looking sort of like late 2023, early 2024 as the most likely time frame that we'll see a recession in the economy. We like to think it's going to be a short, sharp, I guess, slowdown. The longer it takes to get to that recession, the more problems you're building up in the economy from a credit perspective. So the sooner this happens, we think the sooner you get that clearing event, and then the market's view on the direction of interest rates is actually very clear, and that could be a really nice setup for equity markets.
I see. So based on what you just said about the recession outlook, what is your outlook of U.S. large caps throughout this year?
Yeah, so we're pretty defensively positioned as we stand right now. We try to buy growth companies that are exposed to innovation and disruption, but we also want to be exposed to those companies who can show durable growth through the economic cycle. So we're relatively defensive position with a little bit more of that sort of durable growth element to our portfolio, and really wanting to own companies today that we're happy to own on the next 2-3 year view, sort of through the recession and out the other side. We're not trying to get too cute or too clever, try to sort of pick companies that sort of be tactical in our allocation in terms of stock picking. We're just trying to find those companies we think are fundamentally poised to do really well on that 2 to 3 year view.
I see. Do you have any recommendation, like sell or buy, or for any individual stock or any individual industry?
Yeah, I mean, it's I guess so the main areas I would just really want to sort of highlight here would be in technology. I'll give you a couple of names. Firstly, Asml. It's a Dutch company, but we get to own it in our US strategies. Leading lithography semi-cap equipment company. I'm sure a lot of your followers would recognize that company. Also, NVIDIA. As we gain more confidence in recovering that business. They were exposed to some of the most exciting, fastest growing markets out there, and the ability of their product, their graphic processing units to deal with things like AI, machine learning, full self-driving. Though that's the kind of chip architecture which does very well in those environments. So it's found itself in sort of the sweet spot of a number of different end markets, which are now sort of inflecting higher into interest and growth. And then just sort of on that more kind of durable growth I mentioned earlier, we have a large position in US medical healthcare, which we think is a very sort of long-term, durable, growing area. So growing sort of like 13-14% year in, year out. And we think that kind of durability of growth is also really, really valuable.
Okay, I see. I think this is all for today's interview. Thank you very much for sharing your precious time today, and I hope to see you maybe next time. 자, 월가월부 시청자 여러분, 지금까지 티로우프라이스의 줄리안 쿡 미국 주식 포트폴리오 스페셜리스트 모시고 미국 증시 주요 이슈에 대해 좋은 말씀 들어보았습니다. 여러분들 시청해주셔서 너무 감사합니다. 안녕히 계십시오.